Since the start of 2026, cocoa prices have been falling sharply after reaching record highs just a year earlier. What's driving this shift and what does it mean for the outlook ahead? To break down the latest StoneX analysis on supply, demand and price dynamics in the global cocoa market, I'm joined today by its author, StoneX Brazil market intelligence analyst Lucca Bezzon. Thank you for joining us, Lucca.
Hello, Fiona. I appreciate it. It is a pleasure to be back here.
Lovely. Let's jump straight in. Prices have dropped roughly 50% in just a few months. What's behind such a sharp correction?
Yeah, we've seen a very sharp decline on prices, especially since the beginning of 2026. We're seeing currently much closer normal levels than we've seen since the year of 2024. And the main driver behind this is a fast repricing of the market's global balance outlook. Last year, cocoa futures were still carrying a very large scarcity premium because the market was dealing with consecutive deficits. That is, when demand surpasses the global supply outlook, especially because there was a severe supply shock in West Africa during the harvest 23-24. Especially since the start of the year, however, the narrative has changed quite sharply. The market is no longer pricing extreme shortage, but rather a transition towards surpluses and a gradual stock rebuilding. So that's why we're seeing more normalized price levels. And the correction has been so intense because prices were previously trading at crisis levels. So once the market started to believe that supply conditions were improving and demand especially was weakening, that risk premium decreased very quickly. In that sense, futures are moving a bit ahead of the physical market because we're still anticipating some of the fundamentals expected for the 26-27 harvest that haven't yet started, that will start in October only. And the normalization of prices is getting ahead of that expectation.
Now, you briefly touched on West Africa there, but how has the global supply outlook changed, particularly in West Africa?
Well, West Africa remains the most important region because Ivory Coast and Ghana still account for roughly 60% of global output. It is a very concentrated market. But what changed in that region is that they're no longer facing the same degree of stress that they've seen in the harvest 23-24 and some of the harvest 24-25. Weather conditions have been more favorable, with more regular rainfall and phytosanitary pressure being less severe than the previous cycle. That does not mean, however, that problems have disappeared. Structural constraints remain very important. For example, aging tree stock, limited use of inputs, lower farm level investment, especially after the drop in prices that we've seen recently. So I would describe the current situation as a partial recovery rather than a full recovery. Even so, after such an extreme shock, the market does not need perfect normalization for prices to fall. It only needs evidence that the worst phase of the supply crisis is no longer intensifying.
And the report highlights a shift from deficits to surpluses. How significant is this change?
Oh, it is a very important one, and it is a structural shift for the market. Over the past 3 seasons, as I was anticipating, cocoa was operating under persistent deficits, which is the main reason that stocks went to very low levels and prices went up at historical rhythm. And what we're seeing now is a transition out of that regime. The market is now moving from a large deficit in the last harvest, the 23-24, of 490,000 tons of beans, to a small surplus on the last harvest, a bigger one on this harvest, and an even bigger one on the next one. So that's the scenario we're looking at. And the outlook report that we publish goes through the details on each one of them. But the key point here is not just the sign change, but the sequence. So The consecutive surpluses implied that we're having a gradual rebuild of stocks, which reduces the need for prices to remain that elevated as they were for the biggest part of last year.
So demand has also played a key role. What are you seeing on the consumption side?
Demand definitely played a bigger role here, even though we had better outlook for supply, especially with the recovery in Ghana and the better investment in other secondary crops that helped the production. Demand is the biggest point and the most important reason why we're having surpluses, because the industries and the processors are not buying as many cocoa beans that they used to in the past. That is for that there's a very simple explanation. The very high cocoa prices seen over the past 2 years forced the chocolate industry, which is the biggest buyer from these processing companies, to adjust their formulas. We have seen smaller product sizes, reformulation, and a greater use of substitution, especially where manufacturers had room to manage input costs. So, in that sense, they're not needing as much beans as they used to, and they're not buying as much beans from the processors. And the processors, in a consequence, are not buying as much beans from the producers, the cocoa bean producers. And these were not immediate responses. The industry needed some time to redesign products and adapt strategies. But by late 2025 and early 2026, the impact of this consequence became much clearer. The decline in global grindings in the third and fourth quarter of 2025 were the biggest indication of that. We've seen sharp declines on this quarters. And in that sense, the market is not only reacting to better supply expectations, but they're also reacting to the fact that high prices have damaged consumption. And recovery will probably take a bit to gradually come back to normal levels. So that's what put prices down and put pressure on prices the most right now. And for now, all eyes are on the grindings report that will be published in the middle of April that regards the first quarter of 2026. And there we will see if the grindings are still dampened from the higher prices. We expect that during the following of the year, we might see better processing numbers, but for now, they're really diminished, and that's why prices are down as well.
And then looking ahead, what are the key risks and factors the market is watching?
Yeah, so the first key risk is definitely weather. For cocoa and other crops such as weather is the most important aspect when we look at the supply side. And especially for the following of the year, the possibility of an El Nino developing from mid 2026 onward is something that put investors and market participants at a pressure point. Cocoa is, as I've said before, is highly sensitive to temperature, especially, and rainfall patterns. So any deterioration there could quickly change the supply outlook and could diminish the supply that we are expecting. So that's one point that we're probably going to follow during the year. The second is clearly demand. Demand is one thing that has been at focus in the market right now. Even though supply may be stabilizing, demand is still fragile. And if grindings remain weak, that we would reinforce the surplus narrative and keep prices under pressure. But if processing begins to recover, then the downside in prices may become more limited. And that's what we're looking at. One other thing that could impact and has been impacting is the macro and geopolitical factors. We've seen that the commodity class of investment has been favored by higher oil prices and tension in the Middle East over the last couple of weeks. and that has at some sessions incentivized cocoa prices. So that's one thing that we're probably gonna keep looking at more closely.
Well, thank you very much, Lucca. And if you want to learn more on what to expect in the commodity world these next 2 months, I encourage you to visit our platform using this QR code. Thank you for watching.